This is Danny Gallagher, CEO of Process for Growth Consulting. When I started to put together this presentation on big data AI, I had an entirely different point of view that I wanted to make to the FAs. In the end, the presentation changed my point of view. Now I look at FAs managing money, our firm's technology spend, and our business models through a different lens. Like all looks into the future, we normally see many different avenues that we can take. But I've come to realize that the choice of avenues are different than I originally thought, and the implications could, and I believe will, change the foundation of our offerings. So today, we will discuss big data AI as it pertains to our firm's technology spend, standardized investment models, and the new wealth management and business CRMs, and how they will affect the two continuums of change that we face, becoming a wealth manager and changing our investment value proposition. Technology is changing the landscape of investing on several fronts, and these changes have real-world implications for financial advisors. First, fee compression is here, and it looks like it's only going to continue. PFGC believes that the technology driving fee compression is ETFs. ETFs are disruptive technology, not just another investment vehicle. The adoption of ETFs is going to pressure our fees, and PFGC covers this in depth in the Retention Attrition webinar. If you have an interest, please contact PFGC. This fee compression will drive us, FAs, to manage larger amounts of assets as we work to maintain our lifestyles. Big data AI will change how we manage these assets. Second, technology has made it more effective and efficient to manage large amounts of assets by using the firm's trading platforms and models. We need to start adopting the firm's model or models from the asset managers for our smaller relationships. But moving to standardized models to free up time for asset gathering and wealth management raises new bottlenecks of client coverage and efficient tax harvesting. Technology is not the problem here. It is our solution. Third, FAs will have to move to a relationship wealth manager model. 84% of high net worth clients want FAs to address all their needs and goals, not just investments. This will be a challenge. So if FAs want to maintain their lifestyles, they will have to become relationship managers managing larger amounts of assets. Therefore, we're going to have to become much better asset gatherers than we are today. Managing money as our main skill set is also at a crossroads, and we need to understand the future of investing so we can adjust our business models accordingly. This webinar will look at the two main emerging technologies, big data and AI, and the challenges and the opportunities that they present. PFGC developed this slide about 15 years ago, but recently updated the slide to add robo-advisors. With the belief that transparency of fees would lead to fee compression, PFGC has taught that standardized processes, articulation, wealth management, relationship management would allow us to manage larger amounts of assets. This includes standardizing our investment processes by using models. The new trading platform and models have allowed FAs to manage their books more efficiently and effectively, and by using ETFs, we can manage our portfolios at a lower cost, more tax efficiently, and with better performance. Tiering our clientele is critical as we want our smaller accounts to be on the firm discretionary models or robo platforms. PFGC tends to disagree with the firm's small account policies. The hardest thing to do in our business is to gather new relationships and new assets, and FAs are struggling to manage their larger books. The average FA book is 160 relationships, and we are told to give away the D book or just get rid of the assets. PFGC believes it is our business model is not scalable to manage large amounts of assets, then we need to change our business model so we can, and not to get rid of the assets, which are the hardest thing to acquire in our business. The bigger challenges FAs face in growing their relationships is threefold. First, standardized models are better than no models, but we still have to manage each client's tax loss gain harvesting on an individual level. We cannot take profits or losses across our book as each client has different tax needs. For a large book, say 300 to 500 relationships, this can be a 2 to 3 month process at the end of each year. Modeling doesn't scale tax selling. The second big challenge is I've seen with 300 to 500 relationship books is that the team's overwhelmed by the sheer number of calls and workflows. Third, we, FAs, have never managed our client money to metrics. This will have to change. Because of technology, these three issues PFGC believes will not be roadblocks in the not too distant future. Let's talk. The last 20 years of our lives have been dominated by the continuous march, or should I say sprint, of new technology. Technology brought us a new terminology, creative destruction, a process from which something new brings about the demise of whatever existed before it. In the past, this process of creative destruction happened over several decades, but today, technology is moving the process at light speed. 10 years ago, the iPhone. 7 years ago, Uber. The GPS app Waze was launched in 2012. Today, we are faced with more new things than at any time in human history. It is a great time to be alive, and a little unsettling at the same time for the existing business models during this creative destruction. Networking was the dominant technology trend for 10 years. We went from an isolated smartphone to a phone connected to the world. Next, the cloud brought in the era of sharing, photos at first, automatic updates, documents, and workflows. Then GPS. Now companies are capturing our every trip, walk, internet search, post, purchase, food order, review, and photo. The next big thing is the marriage of two major trends, big data and artificial intelligence, AI. So let's take a glimpse at our future. What is big data? Supercomputers have enabled the storage of historic levels of data, and the human race is creating data at historic rates. As we start exploring big data and AI, we'll discuss how these two disciplines are converging to build an alternative methodology of information aggregation. The reason big data and AI are mentioned in the same breath is that we, as humans, cannot manage big data. It is beyond our capabilities. We need AI to actually run the infrastructure of big data. Forget about running algorithms. By every metric, we are at the dawn of the information age. We are creating 2.5 quintillion bytes of data every day, however much that is. We are currently analyzing 11% of all this data, which is predicted to grow to about 23% in 2020, but 23% of a much larger universe. This enormous creation of data is changing the very definition of data and creating new aggregation information data sets. We are able to start analyzing big data because of the development of AI. Still in its infancy, AI gives humankind the ability to work with large amounts of data to change data into workable, meaningful information. But like we have seen in several new technologies, the adoption rate is between 5 and 10 years, not 20, 30, or 40 years. One of the main components of the new disruptive technology is the speed of adoption, the ability to scale. I think we all believe that somehow big data AI is disruptive, but we must realize that we are being disruptive. Our industry is a leading adapter of big data AI, and it makes total sense. Our whole business model is to understand certain data points and extrapolate if the data points mean that a stock will move up or down. Whether you use fundamental or technical analysis, our whole industry is based on data. We have clients, people, and in today's world, we are capturing unprecedented amounts of personal information that we can use to better our services for our clients. Just look in the mirror and you will see a person who's being disruptive. The laws in the investing universe that we operate under were developed in the 1930s to ensure as much possible a level playing field when it comes to information dissemination. Ks, Qs, annual reports have to report certain information on certain time frames to all investors. Investors who accumulate a certain percentage of a company's stock have to report this accumulation in a certain time frame. Analysts and FAs use this data to develop an opinion on whether they buy or sell a security. Fundamental analysis is one of the main disciplines investors use for stock analysis. But big data AI has allowed investors, hedge funds, to develop new data aggregations that they can use in real time. Let's take a look at these new data aggregations. But first, Even the old ways, like fundamental analysis, are being disrupted. 9 hedge funds have the access to supercomputers. And we know them because they are the hedge funds that announced they haven't had a losing trading day in over 1,500 consecutive trading days. Yes, they have an advantage over us. Not even Wall Street firms have the same access as some of these hedge funds. Look at HFT companies. 5 years ago, books were written about them, but today their revenues are down significantly. Speed is not a long-term competitive advantage. Today, HFT firms are more utility-like, providers of liquidity. But the history of the banking house of Rothschild taught us that information is the ultimate long-term competitive advantage. Which brings us to Kensho. Kensho was started by 2 guys from MIT. No financial experience, but supercomputer geeks. Wall Street firm runs teams of people, 30 to 50 people in size, that rely on Excel spreadsheets to work out their what-if economic scenarios. These are not ordinary Excel spreadsheets, but sophisticated, complex number crunchers. After GDP numbers come out, they will run all the interrelated spreadsheets to determine the answer. If this is true, then buy this stock and sell this sector. This process takes a firm normally 2 to 4 weeks to work through. Kensho allows them to do it in less than 5 minutes. Not many people will be running spreadsheet at investment banks in the future. The big investors in Kensho are Goldman Sachs and CNBC, and clients of Kensho are Bank of America, JP Morgan, Citi, and Morgan Stanley. Kensho believes in the democratization of financial information, so they publish for free seasonal odds on CNBC. This is where stock sectors on a historical basis are higher or lower during certain times of the year. Every year, Apple goes up before Christmas, then sells off. When Kensho published for free all the stocks and sectors and their seasonal moves, they got a lot of hedge funds calling them to say, how can you give this away for free? This is how we make money. So I think we can assume that we'll be challenged on several levels. Pricing for sure, new investment vehicles, and new data aggregations with specific timing recommendation. This is a screenshot of just 3 recommendations. There are many more on the CNBC stat site every day, and they highlight what Kensho brings to the investment community. After the ISM manufacturing surprise, buying the industrials on the report and selling 2 weeks later generated a 2.27% positive return. In the bottom right-hand corner, if you buy the IT sector after January-February timeframe, in other words, for March, you make about 1%. These particular recommendations are not very useful for an FA because we do not run standardized models. We cannot make instant decisions across our book because of tax considerations for each individual, and we just do not have the physical capacity to act. That doesn't mean the recommendations aren't valid. It just means that we don't have the ability to take advantage of them. So like all new things, we have new words when we have to invent to express a new function. Like Google, now Alphabet, it was a company and it's also a verb. We Google the answer. For us, big data AI has created whole new data aggregation methodology called alternative real-time data. And it's used in supercomputers running trading algorithms managed by AI. The combination of fundamental analysis, alternative real-time data, historical data, technical analysis, along with momentum and volatility are expressed as quantamentals. Quantamentals is real-time, individual, verifiable, and attributable. The goal of big data is to, put it in their terms, is to catch in the act. Let's look at some of the alternative real-time data sources. The new thing is alternative real-time data. This is an immense threat to our current business model of picking our own stocks and managing our own models, but it is also a powerful solution for the FA's ability to scale their book. There are many more companies and services that are coming online, but let's look at a few that are creating new and real-time data sets made up of immense amount of data, and this data is highly personal. Our cloud-connected smartphones are creating data at an unprecedented rate. The numbers on this slide are generated every 10 seconds. This is highly personal, valuable data. Facebook has deep text, which watches all your clicks, photos, searches, and comments. Facebook uses deep text to analyze all posts, private messages, photos, and videos. So it can figure out what your buy signals are so it can sell you at the moment before you decided to buy. As they say, they already know what you will buy. They want to capture the moment immediately before you buy. Catch in the act. We need to realize that our ability to capture information about our clients, to deliver the services our clients want, is equally important to us. We are just starting. We are moving from 10 billion connected devices to 50 billion connected devices by 2020, and they are all generating data, new data aggregation data sets. You have no idea. RS Metrics satellite services generate highly accurate chain-wide retail traffic growth data by counting cars in the parking lots and truck deliveries that provide investors and operators with deep fundamental insights and signals that are predictive of quarterly beats and misses, analyst changes, and stock price alpha. Think of what they are saying. They are predicting analyst changes. Analysts who are paid millions of dollars in some cases are now just a data feed. RS Metrics tracks, compares, and benchmarks traffic trends for over 100,000 commercial real estate properties such as malls, shopping centers, and standalone stores in real time. Another expertise is RS Metrics reporting in real time of growth of global stockpiles of copper, aluminum, and zinc at hundreds of global smelters and storage sites that are highly predictive of exchange prices in real time. We work off of quarterly reports that are issued 4 to 6 weeks after the quarter ends. In other words, 4 to 4.5 months after the trading program have the information. Cargometrics was started by 4 billionaires. Cargometrics has 120,000 ships with sensors on them around the globe, real-time data. They privately ran a commodity hedge fund based on this data for 2 years, and late in 2017, they announced that the results were more than satisfactory and they were going live. Their goal is to double the number of ships with sensors while integrating new alternative real-time data streams into the model. Look at Maersk last year. To everyone's surprise, they sold a global energy business and announced they were putting sensor on every container shipped, and they will sell the data in real time. Maersk is the largest container company in the world. Foursquare is capturing foot traffic and reviews it in real time. Last year, the CEO of Foursquare announced that Apple sales would be down 17%, Chipotle 26%. No one on the street was close to either one of those numbers. He hit the numbers exactly. Foursquare sells the firm's data to investment models in real time. This is all based upon traffic captured through their app. AirSage delivers the promise of catching the act. Media companies, businesses, investors, transportation planners, retailers, and travel have access to real-time data that they can use for modeling and insights. These massive new data sets are studied to understand complex questions with predictive trend analysis. Metrics in the future will be a probability-based world. Do you know if it's statistically significant if the probability is 88.2% versus 93.3%? Maybe not today, but tomorrow we most certainly will. Look at the CNBC Ken Show stat page. Probabilities. Where are corporations, private equity, angel investors betting their money on the new competitors? Real-time downloaded data sets into trading platforms can transform our ability to understand market share, pricing power, customer adoption rates, and earnings sustainability, all in real time. Predictive intelligence into the company's health and momentum so we can identify tomorrow's winners and future threats. Real-time data for real-time trading platforms. Less than 10 years ago, Uber's initial funding round was around $250,000, and Yellow Cab's medallion was worth $1.2 million. Today, Uber is worth $60, $70 billion, and a medallion is trading for less than $200,000. BlackRock is the largest asset manager in the world, nearing $6 trillion in assets. In late 2017, the #1 asset management firm in the world, located in the financial capital of the world, New York City, fired half their human asset managers and gave the money to SAE, Systemic Active Equity, a division of BlackRock, and moved their CIO, Mr. Wiseman, he's the chief investment officer in the Americas, who oversees 2/3 of BlackRock's assets, to Silicon Valley. What am I missing? BlackRock's stated goal is to marry fundamental and quantitative analysis, quantamentals. The information age, by all metrics, is just beginning. Sensors, phones, apps, web searches, emails, social media all point to a world where real-time data will be captured and analyzed in supercomputers in minutes, if not seconds. If you are a company that sells widgets and only captures the point of sale, it is probable, that investors could have deeper insights into your customers than you do if you do not have these data feeds. We do not want that to happen to us and our clients. We need to work to understand our clients and their needs and goals. So, we are back where we started. Models are the answer, but the question now is who is best positioned to run those models? PFGC believes that we are wealth managers who gather assets by initiating new relationships. Assets are what drives profitabilities of our business model. But building a standardized model is only the first step, but not the final step to our future business model. It is a very important step, though. Standardization should free up time for us to change our business model to build new relationships and to do the work necessary to be a wealth manager. But these changes do not happen overnight. PFGC believes we have to think through two main continuums of change. First, our skill sets from a broker, financial advisor, to a holistic wealth manager with the proper training and designation. PFGC estimates that this could take us 10 years. Next, our value proposition is being challenged. Whether we like it or not, clients do not perceive us as value added, or at least not value added enough for the fees that we charge. The incredible movement from FAs to an ETF company models will destabilize our pricing model. PFGC believes that all the BDs added up experienced in 2017 little or no growth in net new assets. This is not a one-off. This has been the case for the last 30 years. Organic growth has not been a strong point for FAs. Yet Vanguard, with no FAs, increased net new assets by $292 billion in 2017. ETF flows for 2018 are so far outrunning 3 times larger than last year's $492 billion. In fact, if we extrapolate out the first week of March 2018 ETF flows, it was a record 2.4 trillion run rate. We are being disrupted. As we enter into this new integrated world, we must understand our clients to be looking at themselves in a more integrated fashion. We know that a client solution is predicated on 3 different disciplines: investments, taxes, and estate planning. What are the next steps we can take so that in the future we can offer what the clients want? I believe it will take 10 years for us in the industry to attain the status of holistic wealth managers. Doesn't mean some of us are not wealth managers today, or that others employ some of the skill sets of a wealth manager, but on the whole, 99% of our revenues that we generate come from investment. The litmus test for me, if we are holistic wealth managers, is, are we prepared to move to the advice model like estate planning attorneys and CPAs and charge a fee for advice? So far, I've had no takers. What are the next steps, since we will not wake up 10 years from now and be a holistic wealth manager? First, designations, in particular the CFP. The CFP teaches us a process for understanding our clients in a holistic manner. Again, it's not a panacea, but it is a beginning. Next, incorporate an in-depth discovery process. Less than 1% of FAs have a discovery process, and just slightly more have used the financial plans available to us. This has to change. If our fees for investments compress, then our ability to identify other needs that we can solve for our clients will help us maintain our lifestyles. If we understand our clients' needs and goals that don't involve investment, we will have to improve our process for introducing internal centers of expertise to assist in delivering these solutions. The examples are mortgages and insurance. Finally, adopt a new firm AI-driven CRMs. The average FA has 160 relationships, and we don't contact 40% of them for more than a year. What is our value prop versus the robos? Human touch? How about any touch? We need to realize that we may be managing 1,000 relationships in the future. We cannot do that without integrating ourselves into the AI-driven CRM. I don't believe we have to be futurists to see a day 10 years from now where our clients' portfolios will be AI-driven, tax-efficient, direct indexing firm models built on each individual's risk profile, maintained in real time and integrated into the total financial world of the client. Technology spend by your firm will be the most important component of your success. Your firm's ability to drive AI-driven direct indexing models that maximize each client's tax situation will be critical. The first step today to a market of one is to adopt a standardized investment model, preferably based on tax-efficient ETFs. You can use a model from your firm or an asset manager. State Street has developed low-cost ETFs developed especially for modeling. Find one you like. Next, take small relationships into the firm models. As the firm models increase their delivery capabilities, alternative real-time data, and tax harvesting, we will move larger and larger relationships to the firm models. The average BD has over 1 million accounts under 250,000 and a total of 75 billion in assets. All these relationships need to be matriculated to the firm models. Run your models against metrics. You can use State Street, Vanguard, Morningstar, or BlackRock, or anybody else for that matter. But metrics are a necessity. No longer can we answer, this is the way I invest. Now it is why I invest this way and back it up with metrics. Get your Certified Portfolio Manager designation, CPM. Not to learn how to build a portfolio, but learn how to explain all the metrics in designing a portfolio. Up and downside capture, volatility, momentum, liquidity, exchange rate sensitivity, style, leverage, and performance attribution. There's no more trust me investing. If robo-advisors changed anything, it is that they can tell how and why they invest a client in a certain way. Finally, adopt the new AI business-driven CRMs that firms are rolling out. By understanding our clients better, the AI business CRMs can help us deliver services and products as we catch in the act our clients' needs. But in the end, I think we can see a day when portfolios will be big data AI driven with individual tax management, direct indexing firm models based upon each individual's profile. There are many paths that we can see that lead to the future, but we are starting to get some clarity on possible outcomes. Clarity over certainty. The future is far from certain, but clearly we can see that our existing business model is morphing rapidly. First, it seems to me it is difficult to defend the stance that we will be managing money for clients in the future. We are at disadvantage on information flows, computing power, time, and speed. Our business model is calling for us to manage a lot more relationships and assets, and our solution is the adoption of all these new technologies. So I infer from this that your company's technology spend is and will be a major competitive advantage. But more important, it is a necessity to our survival. Already, the technology spend by the BDs has a great variance. My opinion is this will lead to the RIA market drastically changing as they are not investing in a new integrated technology platform. And the key word here is integrated. Asset managers will move from product to models, solution. AI will drive most efficient models based on all the data points and many more as we discover meaningful trends through in-depth analysis. The true robo-advisor's clients will be a financial advisor on a platform that understands their client's risk and behavioral profile, their current needs, and their long-term goals. Based on this analysis, our platforms will run big data, AI-driven, direct indexing, tax-efficient models. The future is not here yet, but we can already see the seeds of our future with the firm's new rollouts of interrelated wealth management advice platforms and the new business-driven CRMs. Technology is disrupting our business model, but is also offering a way to the future. Adopt, adapt, and change. And thank you for your time. Any comments or questions for the good of the whole?